Hi, guys, and welcome to episode 7 of WTW, the weekly trading wrap up for the week of December 29th, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. As always, here we're looking at a chart of the S&P 500, the SPY, okay, and this is the week of the end of 2024 and beginning of 2025, spanning 2 years. So here we have Monday, Tuesday, Thursday, and Friday. And as you can tell, we gapped down on Monday. This is the Friday's close. We gapped down on Monday and pretty much stayed on the same level for the entire week, a couple of scares in midweek, and then on Friday today where I'm recording this, we had a big up day. Okay, so let's talk about what happened. Looking at this week, we didn't have a lot of macroeconomic news, but we had a bunch of PMIs, a bunch of purchasing managers indexes, or indices, I should say, coming out. But we'll focus on one and ignore the others. For example, on Monday, the Chicago PMI came out and it was lower than expected. It came out at 36.9, which is very low, versus 40.2 previously. So Chicago is doing much worse than the previous month and it's getting very bad. However, we don't care about Chicago alone. We ignore this one. We look at the ISM manufacturing and non-manufacturing index when it comes to the PMIs. So we can ignore the Chicago one. And also we had pending home sales. Forget that. Like we mentioned last week and on multiple weeks, that's we don't look at the pending home sales because they're not leading indicators. The one that we look at is building permits because it eventually leads to housing starts and then housing completions. So in terms of macroeconomic data, we can just discard this piece of data right here. So let's talk a little bit about this action here on Monday. We gapped down, and here there was a lot of fear in the market. Okay, we already had fear, and we're going into more fear here, and it extended throughout the week. So Monday, as I was looking at this, the fear and greed index, which I like to look at, which was right here. Well, on Friday it closed at 32, but it was around this 30.29 level on Monday, this candle right here. Okay. So I was looking at it here and it reminded me of this action right here. The major August 5th, let's say here was Thursday, Friday, like beginning of August, and then August 5th, the gap down. This was the Friday and this the gap down Monday. Let me make it clear here. So we can go higher, you can see it here. This is the Friday, this was the Friday. Let me make it even more clear. What are we looking at here? Okay. This was the Friday, and this is the Monday action. So here, if you can recall, I remember living it. On Friday, it was a bad day, like it was here. Gap down, not as much as here. This was much more fear, much more panic. This was the unwinding of the Japanese carry trade, among other things. So here we had a Friday that was gap down, and then a Monday open that was gap down, and this is the Monday open on huge volume. Here, the Monday open wasn't on huge volume because it was a very shortened week, but here there was on huge volume. So it wasn't exactly a parallel, but it reminded me of this day because we had two gaps down, and this looked like an exhaustion bottom to me, and it finished on an indecision candle, which means nobody knows what was going to happen next. Okay, so to me, I thought that this was drawing parallels. I thought that there was going to be another down day that would have marked the bottom, and then we would have opened Tuesday higher, which would have made a very bullish island reversal pattern. Okay, that's not what happened, but that's what I was expecting. And here we were at fear, but not at extreme fear. Okay, So that's what I was thinking going into Monday. Of course, that didn't happen, but that's what I had in the back of my mind. I was really starting to get very, very bullish after this because I was bullish here, but I didn't expect it to retest. Okay, it did. That's the market. You never know exactly what's going to happen in the future. But this is what I was thinking would happen, and then we would continue up higher like before. But apparently that didn't happen. So let's just kill this for now. That was my mindset going into Tuesday. Okay, so that's it for Monday. And what happened on Tuesday? Well, on Tuesday it went down again. Almost nothing happened from Monday, Tuesday, and Thursday, and only Friday was the big action rebound. Okay, but let's go to Tuesday right now. So there was no macroeconomic data to speak of, and it was the end of the year, end of the month, end of everything, and this brought about the end of tax loss selling season, which is big in the gold sector. Okay, so let's look at the gold sector and what happened. Let's just look at gold. Okay, now I'm looking at the gold. CFDs is contracts for difference, but pretty much the gold price. Where was Monday? Monday was right here. Let's mark it with an arrow. Up arrow. I'll do an up arrow. This one right here. This is Monday. Okay, so gold started going down on Monday. Okay, still the narrative on the gold front is that rates are going high, and gold is going to get killed because of that. Okay, and the dollar's going up, so therefore gold is going to get killed. And that's the same narrative that happened going into today. Okay, so we see that happening. However, I realized that this whole time was tax loss selling. Okay, so this is a good time to accumulate. And if you follow me on Twitter, like I keep mentioning that tax loss selling was happening, you should be accumulating golds throughout December, but especially towards the end of December. Okay, so this marked for me the watershed moment in buying gold and gold stocks. Okay, so if we look at gold, you can it's still in a consolidation pattern after this huge move upwards. Huge move up. This is just a consolidation pattern. Nothing really crazy going on, despite all of the negative news on yields rising. And they did. The US 10-year that we always look at was rising. This is Monday. Okay, it fell on Monday, so that was very positive for gold. But which this is Monday. It fell on Monday. It should be positive for gold because yields are going down, but no. Gold went down because of tax loss selling. Tax loss selling dominates, especially when you had a situation where gold rose for the whole year. So gold is super positive. There's no reason to sell gold because it's not experiencing a loss. But the gold miners, this is GDX, you can see it's been going down. It hasn't been going up, and it's not even close to at the highs, okay? Recent highs, like here, it's not even at 45. It could be in the 60s if we look at the highs of 2011. So gold miners were experiencing tax loss selling, even though gold wasn't. So what does that mean? Like if you look at the ratio of GDX, which is the gold miners, divided by gold, you could see tanking throughout all the entire year pretty much. And in December especially, look, this is December, okay? December started here, massive sell-off, okay? Because miners are being sold off for tax loss selling, okay? So let's go back to gold here. So that's why on, where was it? This is Monday. Tuesday, gold went up a bit as GDX went down. You can see it here. Monday, GDX was down from the previous day. This red candle here is Monday for GDX. So it went down. Last day of tax loss selling, it's beautiful. You want to accumulate because as you can see, you get a snapback going forward. Okay, so I just thought I'd mention the tax loss selling came to an end on Wednesday. Okay, on Tuesday. So now let's go back to SPY and let's go to Thursday. Okay. Thursday, the market went down big. Okay. What kind of news did we have coming out on Thursday? We also had the S&P Global Manufacturing PMI. That came in at 49.4 versus 49.7, slightly lower. But again, we don't look at this PMI. We look at the ISM, the Institute of Supply Management PMIs. Okay, and those are going to be coming out on Friday, which we will get to very shortly, but not right now. Okay, and the other big piece of economic news that you should look at every week, and it comes out every week, is the initial claims figure. Okay, and we were looking at that to not explode, because if it explodes higher, then we mentioned it before, we're getting close to recessions. Okay, and our narrative going forward is we are bullish because the economy is doing okay and the jobs are holding up. Okay, so what did the initial claims come in at? This is the initial claims from Trading Economics. I love this site. It gives you a lot of free data. On Thursday, it came out at 211,000, which is very low. As you can see, the previous week was 219. So initial claims are going down or staying in this level, in this range. Okay, this is significant. It's telling us that people are not filing for unemployment. They're not making initial claims. And what are the continuing claims doing? Well, the continuing claims came in. Well, I don't have that, so let's look it up. The continuing claims also went down. 1.84 million versus 1.91 million. That's good. You want to see the continuing claims also going down. It buttresses our argument of a strong economy and the consumer is healthy, they have jobs, they're not filing for unemployment. So both of these figures, the continuing claims and the initial claims, are very positive for jobs and for economic growth. As you can see, like you can tell, like the initial claims have been going down, and they pretty much forecast what the jobs numbers are going to be. The non-farm payroll report, which everybody looks at, it didn't come out. It's not going to come out this week. It's going to come out next week. But we have an idea that it'll probably be favorable or it'll hold up because we don't see any vicious moves in initial jobless claims. Okay, which tends to signal what the jobs report is going to be. It's not 100%, but it gives you a clue, a little hint about what the jobs are going to be. And to me, I'm thinking that jobs are going to hold up next week. Okay, but that's neither here nor there. What is important is that it supports our argument of decent GDP and jobs are holding up. Okay, so that is an important thing that came out on Thursday. So let's go back to the S&P 500. And this is Thursday. So why did the market tank? It looks like the market went even lower. So we had extremely depressed sentiment here, extremely depressed here, bad sentiment here, and even worse sentiment here. Here, it went, actually the fear and greed index went into extreme fear temporarily. Okay, so you had extreme fear happening. Why? Well, the only piece of news that I see coming out here, well, two pieces of news. We had the 15 and the 30-year bond auctions, which showed that interest rates are going higher for the 15-year, which came in at 6.13%, and the 30-year bond came in at 6.91%, which is higher than what was expected, because it's all based on the US 10-year note on Thursday here. Yields in general going up. Okay, even though on Thursday it actually held pretty much flat, you can see that if you look at the 20-year, the US 20-year went slightly up or even flat. So the rest pretty much tell you what the US 10-year is telling you on Thursday, which is this red candle right here, is that yes, yields are going up, but if we look at perspective, it's still not going higher than these levels. It did break this previous pattern, but this could serve as resistance and it could further go down. Okay, because I don't believe we have massive inflation coming in. There's another issue on the table, but we'll get to that coming on Friday. Okay, so this is why the market, I think, got scared. It's on Thursday and went into extremely oversold territory. By the way, this past 2 weeks has been very, very bearish. Despite these 2, 3 days, we never really got past the fear level in the CNN Fear and Greed Index. Like for 2, 3 weeks, we've been operating in fear, okay, based on the increased yield narrative. Okay, that is the narrative that is sticking right now. Okay, any reversal to that, and you're going to see a huge rip in markets and gold and everything that has been depressed in relation to that. So when you have such depressed sentiment, and we're really still super close to the all-time highs here, this is telling me that the market is consolidating, working off these overbought conditions, and we're ready to rip. Because despite all the negative talk about high yields, we're still near highs. So that should tell you something, okay? And as you can see on Thursday here, as it fell, we're going to look at the VIX, which is the fear index. It went as high, close to 20, okay? Still not spiking, but it went close to 20. Not enough to scare everybody, but it surprises me that despite such negative sentiment, such negative market action, let's say, or red candles, I shouldn't say negative market action, it's actually pretty good if you think about it, because it's alleviating the overbought conditions, getting people to be scared, which fuels the next rally. And as I said last week, I think I marked a spot here. I could think the S&P 500 can get to 620, 630 in this rip. Because as conditions go from fear to greed and into extreme greed, we have plenty of fuel here to get to this level up here. I just marked it as a reminder, but it's not that important right now. It's just a forecast. Doesn't have to happen. Okay? So that's what happened on Thursday. We had this fear. It got us into extreme fear, and this is where I was even bullish. I bought even more stuff here to match the stuff that I was buying here. Okay? I'm really expecting the market to rip in the coming weeks. Okay? So what else happened on Thursday? Well, we talked about gold here and gold miners. Okay? So let's go back to that, because something that happened on Thursday really piqued my interest. Because it's a very rare event that I haven't seen in a long time. Okay, so you see gold. This is Thursday right here. Gold ripped. Okay, higher. It was up 1.27%. But what's even more noteworthy is that this is GDX. Okay, this is Thursday. It ripped even more. It was up 4% on the day. Okay, this is telling you that after tax loss selling, it's like a beach ball under the water. People want to buy the gold sector, okay? Because they've been selling it and then they want to buy it back. They've been selling it for tax loss reasons, just to offset capital gains that they had for the year, so that they don't pay a huge tax burden. They just sell their losers here, which is gold stocks, and then they buy them back 30 days later, okay? And this is what's going to happen. Because they still want to hold those shares. They just want to pay less taxes for 2024. So, like you see, it ripped like a beach ball on Thursday going up, which is very rare because the S&P 500, as we mentioned, was down a lot. It was down almost 1% at one point. Okay, like down to here, it was almost down 1%, but it recovered. Okay, or 0.5 to 0.75%. Okay, so that means, like, if you look at GDX versus the SPY ratio, you can see on Thursday how it ripped. This is telling you that this is a ratio of gold miners versus S&P 500 stocks. And as you can see, the S&P 500 stocks have been dominating the gold miners because gold miners have been dying if compared to the S&P. Okay, so this is Thursday's action. You can see that the relationship went up by almost 5%, 4.5%. Okay, on Thursday, which means that gold miners went up with gold as the market went down. That's very rare. Usually you see the opposite. Okay, and I don't see that happening in a long time. Usually gold and gold stocks and the market go together. Like especially when the market is tanking. When the market goes down, you might see gold itself hold like it did on Thursday here. But gold miners would be down because gold miners are still stocks. And when the overall stock market goes down, so do gold miners. So when you see them outperform dramatically as the market is going down, I'm going back to SPY here. As the market is going down here, you saw big green candles in gold stocks. That is a rare event and should be noted. Okay, so that's why I'm expecting good things in the gold sector going forward. What else happened on Thursday? Well, on Thursday we had some uranium news for those uranium bugs out there. Inkai, which is a place in Kazakhstan where they produce a lot of uranium. Kazakhstan is the #1 uranium producer in the world, and Canada is #2. And the biggest uranium company in Canada is Cameco, and you can see this is Thursday's move. Cameco went up because they announced that Inkai production will be suspended. Inkai is a joint venture that the government of Kazakhstan has with Cameco. They share production. Okay, so whatever is mined, Cameco gets to keep it. I think it's a 60-40 split, 60 for the government of Kazakhstan and 40 for Cameco, although I could be wrong. It could be 70-30 or 60-40, something like that. It's been a long time since I looked at it. But you can see that even though it's bad for Cameco, they're not going to get their uranium. It's good for the uranium sector as a whole. So you would see the uranium sector as a whole go up because supply is being curtailed. The uranium story is still good. And if you look at Cameco, it's still on an uptrend, generally speaking. It's just been consolidating after a break to highs. So Cameco is probably the leader in the sector, and you want to be in it if you want to buy it. If you want to have exposure in the U space, the uranium space. So this is good news for the uranium space. However, well, let's look at the entire space instead of just Cameco. This is the uranium ETF, URNM, the Sprott Uranium Miners ETF. And yes, look, Thursday it ripped. Okay, it ripped 7%. The entire index went up 7%. But you can see it's still in a consolidating pattern, despite the fact that uranium is doing fairly well. Okay, so it's still in the consolidating pattern. So just one day. So don't freak out over it. We need a long way to go for the uranium sector to break out again. However, it is good news and something to look at going forward. And the other important news that came out in the uranium sector is that the U.S. government, and specifically Constellation Energy, this is Constellation Energy on Thursday, this big candle, they announced that they will be powering some U.S. government spaces, offices and departments with uranium from Constellation Energy. Constellation has a lot of uranium plants. They run a lot of uranium plants, so they got a deal with the government, so stock went up. Full disclosure, I own some CEG already, so I'm happy about this. But it just goes to show you beyond this nice day that we're having, that the U.S. government is finally getting on board the uranium train. This is a big shift. We saw this happening this year, all of this year, where the Biden administration is actually going on board the uranium train. This bodes well. This is a 5-year story, okay? It's going to take a long time to play out, but it's positive in my eyes. When you have the government that was very much vehemently against uranium because it was captured by the leftist green zealots, I would say. and they were very anti-nuclear. Now they're starting to be pro-nuclear. When the government's starting to be pro-nuclear, you're going to start getting subsidies and grants and favorable rulings down the line for the industry. So that is the good sign. The good sign is that the news involves government approval and paradigm shift in the uranium space, okay, which is good. And that's what really happened on Thursday. So let's go back to the SPY and Friday. Friday, there's no jobs report this Friday, even though the first Friday of the month. But look, the day was just bid. If you look at the 15-minute chart of the S&P 500, you can. This is Friday. Just slow stairway to heaven. Okay, this was 9:30, and this is 4 o'clock. A stairway to very little pullbacks. Okay, that just goes to show you that when you have such extreme fear, and we're still at fear, despite this move. Let's go back to the day. Despite this nice move here, after almost like these could be like a double bottom exhaustive moves here, extremely low sentiment, with the economy holding up. Okay, despite such a move, we had a very good Friday. Okay, which is starting to play out. The contrarian nature of this is starting to play out in my mind. I think this could be a double bottom, and we're going up higher. Okay. And what news came out on Friday that is of note to our thesis? Well, now we actually had the ISM Manufacturing PMI come out. Okay, and this is the one we look at. And if you look at that, ISM, you will see that it came in at 49.3 versus 48.4. So let's look at the, let's make it clear here. PMI for trading economics. Boom, up. This was very disappointing in October. In November, big move up. And now, big move up in December. The December number is for November. Okay, that's all it means. So it's at 49.3 versus 48.4. Okay. This is good. We want to see this going up to the 50s and more, because this is telling us that the manufacturing sector is starting to perk up from lows. Remember, if we go max, we can see that these levels are very lows. They come into troughs, and we're expecting it to go higher. Okay? So not only is the manufacturing sector up, not exactly at expanding, but it's contracting less quickly. So it's hoping to go into a trough and go up, okay? And new orders, which is a subsection of the ISM manufacturing, which tend to lead the ISM manufacturing, is at 52.5 versus 50.4. So new orders are expanding faster in the manufacturing sector. And this is what we want to see. This supports, again, our thesis that the economy is still strong and doing well. And if we can get manufacturing, which has been a perennial loser, if we can get it to perk up, it's going to be a huge boost for GDP. Okay, so we have all this good news coming out. Okay. Oh, and in relation to this, in relation to the ISM manufacturing, is that Biden announced that he will kill the U.S. Steel, Nippon Steel takeover. Like, Nippon made an offer to buy U.S. Steel, and Biden just shut it down. But if you look at U.S. Steel, which is X, okay, this was the takeover announcement here. Came out in December of 2023, and it's been going down since. Because people were anticipating that Biden would probably kill it. Okay, and here they did, and U.S. Steel opens lower again. Okay, so but it was already baked in the goods. But the point of all this is not to show you U.S. Steel or to make a trade. There's nothing to do here, except maybe go long, because it really is hitting these technical levels. But that's for another story if you want to talk about individual trades, which I'm not here to do. Okay. What that does do is show us that manufacturing is starting to become onshored back onto the States, which is good for our PMIs in the manufacturing sector, which again supports our positive GDP picture. Okay, so this is what happened. This is the macroeconomic news of the day that was important, is that the PMIs are coming in at much better than expected. Okay, so we have here good economic news coming out throughout Thursday and Friday. We had the initial claims coming in lower than expected, which is good, and we had now the PMI is the ISM PMI coming out, which is better than expected. So these 2 days gave us good news, which further supports our thesis of a spiking market coming soon due to the very depressed nature and depressed sentiment exhibited over the past couple of weeks. Okay, this happens always. This always happens in bull markets. You will have, it doesn't go up in a straight line. You have ups and downs, and these downs are used to alleviate the overbought conditions, get people to get short or sell their stock, so then it fuels the next rally. This is what I think will happen. And because we got so extreme in sentiment, barely down, the S&P is down 3%, then the ensuing rally I think will go even much higher. That's why I have a target of 620 to 630. Okay. So let's talk about the prevailing narrative of higher interest rates. Okay, because the talk of higher interest rates in the U.S. 10-year. Okay, let's go back to that. This whole move higher is fueled on the fact that inflation is going to be higher and persistent, and it's going to make the Fed not want to cut rates. And we've already seen how the Fed Watch tool says they're only expecting 2 rate cuts in 2025 instead of like used to be 4, and then 3, and now 2. So this is making the market very reticent, and it's igniting fears of higher for longer again, rates being higher for longer. And I disagree with that, okay? But another thing that comes out that is supporting this argument is the news of 7.6 trillion of U.S. government debt will mature in the next year, adding pressure on rates, okay? So Janet Yellen, in her infinite wisdom, refused to renew back in the day when she was the Fed chairman, well, not back in the day, but in this administration, she's the Treasury Secretary, and she didn't issue long-term bonds in 2020 when rates were at 0, okay? Like right here, that's 2020. During this crash, she brought rates to 0. She could have easily financed the government for 20, 30 years at interest rates of like nothing, 1%, 2% max. Okay, and the 30-year rate was 2, 3%. So she could have easily financed the U.S. government for years to come at 2, 3% for 20, 30-year bonds, okay? However, she decided to issue short-term debt, which will mature right now, okay? Short-term debt at almost 0, okay? Because if she increased the maturity of debt back in 2020, like if she issued 20, 30-year or 30-year bonds, mortgage rates would have gone high as well, and it would have killed the housing market. So she didn't want to do it. A little bit of short-term pain we would have suffered, but now we wouldn't have had this quote-unquote problem where 7.6 trillion of U.S. debt will mature this year. So that's also adding pressure because that is supply coming in, okay? And this, I don't know if you can see this graph here. I will explain it if you can't see it, but this top blue line here shows that there are 7.6 trillion of securities that will mature this year. And this line shows that it's 31%, okay? 31% of all U.S. government debt is going to mature in 2025. That sounds ominous, okay? That sounds very bad because it shows massive supply coming in, and this also played a role in the yields going up, okay? But that is like we've had this kind of talk before. We've had these kind of scares where we have X amount of U.S. debt maturing, and it's going to cause a spike in rates, blah, blah, blah. Okay? As you can see here, I've set this up to show you what happens. Look at this date here. It's June 13th, 2012. U.S. debt maturities, evidence of looming default in bonds. Here we see the U.S. debt, U.S. Treasury debt by maturity. And the year 2012 and 2013 is going to be short-term debt is going to mature. Okay, and that will put tremendous pressure on rates. 900 billion has to be paid in the next year. But that in 2012, 900 billion was a lot of money. Now it's nothing. But I'm just telling you that again, this is why TLT is under pressure. Like, it's the same story that we have right now. So U.S. debt maturities what happened in 2012? Did yields explode? No. Okay, because the faulty reasoning here is that they're just looking at one side of the equation, looking at supply. And yes, supply is coming in and it's huge. Okay, but what if demand is even bigger? You don't know. We have a whole euro-dollar market out there, a whole U.S. debt market outside of the U.S. Many countries outside of the U.S. are starving for dollars, okay? And they might just soak up all that 7.6 trillion. You have no idea. The demand for U.S. dollars, ex-U.S., outside of the U.S., is huge. Okay? And we don't know what it is. It's a dark market. So people are making these ominous claims just looking at one side of the argument. It's like you're going into a court case and all you heard was the prosecution's case. You would convict everybody because all you see, oh, this guy's guilty for sure. You didn't even hear the other side of the story. So we've had these scares before, and because they don't know what the demand side is going to be. We have the supply coming in. Yes, we have 7.6 trillion coming in. That we know. That's a given. And look at the market's reaction. In fact, if 7.6 trillion is coming in, which is 30% of the debt securities maturing, I would expect this to be much higher. And it's not. The market's holding up. We all know this. This is known news. This 7.6 trillion that's going to be due in U.S. government debt was from 2023. Okay? It's going to keep Did 2024 explode? No. So it's because nobody knows the demand side. Excuse me. Where are we here? Nobody knows the demand is going to come in. So again, I caution people who think that rates are going to explode due to inflation or the coming debt crisis that Treasury securities are going to be maturing in next year in 2025. It's just, wait, you just have half the story. You really don't know what's going to happen, okay? So just take things with a grain of salt. We already know this. The news is already out, okay? Is it priced in? I don't know. I hate saying that. It's priced in. It's just that's the known quantity. We have no idea of the unknown quantity, okay? So to recap here, we had a very exciting week, even though looks like nothing happened after the gap down. It just pretty much stayed. We saw that positive moves in the gold space after massive suppression due to tax lock selling are starting to play out. We saw that yields are climbing, but are they coming into resistance and starting to fall? We don't know. Okay, I say they are. I say yields are going to start coming down. I don't see an explosion in yields coming. Okay, and what else happened? We had the uranium space picking up a little bit. Okay, so given all this news, especially the positive news due to the ISM manufacturing and the initial claims, our thesis is still bullish. Nothing has changed. Okay, we are near all-time highs with not extreme fear, but fear. And because of this fact, it could have formed a double bottom in the market, technically speaking, to go up to my target here of 620 to 630 in the S&P 500. Okay, so that's it for me. That's it for week number 7 of the WTW, and looking forward to next week, which I hope is going to be good. And given all that we've learned and all that's come out this week, I'm still bullish.